Hello everyone, hello. Subscribe to this channel if you want me to help you, and like this video. First of all, what am I about? Am I about giving you information, helping you? I'm not really telling you what to do, because frankly you could do whatever you want. I don't believe so much in telling YouTubers, hey, buy this stock and do this thing and this is gonna crash. I am all about teaching you, because that's what I do full time, right? I'm a professor. I want to teach you. I want to explain to you what's happening. I want you to understand the decision that you're making. I want you to realize the risk that you're taking. I want you to understand the investment that you're taking. I want you to understand the environment that you're in. And then you make your decision. Do not, in fact, at the end of the day, this YouTube enterprise is for entertainment purposes only. Right? You're not going to invest your money because someone tells you to buy Tesla now and Nvidia is going to go up. Retire in Nvidia, retire in Tesla. Do not listen to this. I know it sounds easy, but over time you need to make up your own mind. Marcus Aurelius said that, you decide what you want to do, and you have to make up your own mind and try not to listen to many people. Make up your own mind and then do your own analysis. So if you're going to listen to someone, he has someone that explains to you what's going on. He's not partisan one way or the other. Okay, so speaking of which, let us talk about the national debt. There was an interesting CNBC interview recently with the CBO, head of the Congressional Business Office, and he's in charge of the budget. He's nonpartisan, right? So he's not a Republican, he's not a Democrat, but he will tell us what's really going on. So let's listen a little bit to what he says, and I'll explain to you what it means.
Our next guest runs the government's nonpartisan Congressional Budget Office. In a recent update, the CBO said that the U.S. budget deficit will rise to almost $2 trillion in 2024.
Now, that is the deficit. That's not the national debt, right? So basically, we are spending $1.9 trillion more than we're taking in every year. And of course, that goes and add to the amount of debt that we owe, which is about $33 trillion globally, and about $27 trillion if you eliminate the debts that's already within the government. Take a look at my preview video on that to have a better feel. But essentially, that's how much deficit we are. That's how much more money we don't have, and we get more in the hole every year. So how significant is 1.9 trillion? Because you don't have that in your bank, and neither does a good friend Elon Musk.
That's the largest amount outside of the COVID era. Joining us right now is the CBO director, Phil Swagel. And Phil, thank you very much for being with us. You've been trying to warn about what the continuing challenges are, and maybe growing challenges are, in terms of meeting some of our budget issues. Why don't you lay out what you think the biggest risks are right now, how much more complicated this is getting?
Yeah, thanks so much. Thanks for having me on. The near-term danger is rising interest payments.
So what does it mean by that? It essentially means that you owe so much money on which you have to pay interest, that the interest alone, forget repaying what you owe, right? When you buy a house, it's over 30-year mortgage. At the beginning, you mostly pay interest, but eventually, you are going to pay back the principal. Here we are just paying the interest. Okay, we're just paying the interest, it's like a HELOC. HELOC, which is home equity line of credit.
Interest payments are nearly $900 billion this year, which is more than defense discretionary spending.
So it's 900 billion. Now we're 1.9 trillion over in terms of spending more than we're getting, and 900 billion every year is the interest alone, and interest alone of 900 billion.
And it's set to rise, right? Rates are, not skyrocketing, but they're higher than in the past, and we have more debt. And so there's rising interest payments. And then by the end of the 10-year budget window, we have the Social Security Trust Fund exhausted, and then the Medicare Trust Fund exhausted just.
So 900 billion, which is basically the budget, the national defense budget. So every year, boom, 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 900 billion. And we're spending 900 billion obviously on defense, but we're also spending 900 billion only on the interest. And at the rate that we're going, in 10 years, there's not going to be enough money for Social Security or Medicare.
After that. So that's the challenge. Things just get much more difficult over the next several years.
What happens if the Fed lowers it?
Now, of course, so we owe 1.9 trillion deficit, which is basically 99% of GDP. We are bringing in 4.9 billion, so revenues, a bunch of taxes and a bunch of other things, and we're spending 6.8 billion. Folks, it's not very complicated, right? If you want to fix this, you got to bring up the revenues or lower the outlay, right? What can we do? What can we do to fix this thing? I'll show you what we can do. You're not going to like it, but that's what needs to happen for you to fix it, right? A, you need fiscal discipline. You have to do spending cuts. You got to reduce government expenditure, particularly with inefficiency and redundancy. It includes reforming the Social Security, the Medicare, the Medicaid, because we don't have enough money for all this. You have to make efficient use of resources, implementing more allocation and waste in government programs. Stop spending money on stuff that we may not need to. Now, of course, I don't know if you notice, there's big things happening between the Democrats and Republicans, between Trump and Harris and Biden, blah, blah, blah. I'm going to do this, I'm not going to do that. You're good, you're no good. But do you hear anybody talking about this? Do you hear anybody talking about fiscal discipline? Yes, someone is saying, I'm going to cut taxes. Okay, well, if you're cutting taxes, you are bringing even less money in. How is that going to fix anything right now? The second thing you could do is, well, let's talk about taxes. Let's broaden the tax base. Reducing tax loophole and ensuring more people pay their fair share can increase government revenue. So basically, we're saying let's raise taxes or make it more efficient. Let's not talk about raising taxes. Let's talk about fixing the tax loopholes. Progressive taxation, implementing or increased tax on higher income brackets can provide additional revenue. Let's tax the rich. Ouch. Okay, so that's too painful. How about something less painful? And that's something that's always a possibility in the US. Economic growth. Stimulating growth policies that promote economic growth, such as investing in infrastructure. So let's grow the economy then. If you grow the economy and if you do job creation, and this is where you hear them banging mostly, then you have more money coming in. Is this what's happening? That's a big question. Now, debt management, so basically Social Security reform gradually increase the retirement age. So instead of retiring at 65, 67, and 70, let's push it. You really want to work longer? You want to get old and die before you collect your money? Healthcare reform, cost-saving measure in Medicare and Medicaid. Do you hear any of this? No. Do you hear any of this? No. Bipartisan cooperation, achieve a political consensus on fiscal policy is crucial. Bipartisan, really? No. Okay, let's reduce the interest payment then. Lower the interest rates. Well, okay, then you could go to the government, and that video is going to talk about. Let's go to the government, and let's well, you can't. The Fed technically could lower rates, but they can only lower rates for their own accord. Now, one thing that we've seen with lowering the rates is that after 2008 and after COVID, we brought down rates to zero. That's great because it helps the stock market, and it would be great because it would lower the interest payment. But is it really making a big dent? I'm not so sure. Let's see what this guy say at the COB. But lowering rates, the Fed has to be independent. They got to do it because they want to do it, because it feels important. But if they lower the rates, which is around 4% right now, and they want to bring it down to 2%, if you get it down to 2%, then at least you have a fighting chance in case the economy slows down and you want to lower rates again to help out. But if you bring it down all the way to zero like we had in the past, and you have a problem in the economy and the economy slows down, how are you going to increase the economy? Because you can't lower rates any further, then you'll be stuck. So the Fed is intent on lowering the rates, but only to 2%, not back to zero. That is not going to happen. We're going to go from 4% to 2%, and that's it. And that's considered success by the Federal Reserve. So that's the lowest you're going to get. So don't expect too much out of lower interest rates. What about structural reform? Well, let's do some government efficiency, streamline government operation, improve efficiency, regulatory reform. Are you hearing any of this out of all the 8 points? Maybe, I think we hear about number 3, right? Forget fiscal discipline, forget tax reform. I guess you could restructure the terms of the existing debt to extend the maturity, and okay, so maybe that could happen. Entitlement reform, no. Policy consensus, no. Reducing it, probably not. Maybe 2 out of 8 is going to happen. Let's go back to the video to see what these guys have to say.
Interest rates, does that save us?
Lower interest rates would help on the federal deficit side, if that means that net interest payments go down. On the other hand, the amount of debt has gone up by so much that even modestly lower interest rates won't change the fiscal trajectory. Oops.
So that is not something you can do right now. Look at the rates, 4.4, 4.24. So even if you were to lower rates, which is basically the Fed to do it, we owe so much money that it's probably not the best thing to do.
I guess when you look at it, though, it does make me wonder if there's going to be pressure on the Federal Reserve to do the right thing, lower rates to make this easier.
So basically what we want the Fed to do is, lower rates like you did in the past, bring it down to zero.
What would the end result be if that does happen?
Yeah, certainly those pressures will be a danger, and the Fed is independent, and its officials have explained that they will maintain that independence. So I think we can put our trust in the Fed. A tension between fiscal policy and monetary policy would result in either higher inflation or higher interest rates that affect the government debt, and that's
higher inflation or higher interest rates.
That's the kind of tension that really could pose a challenge in either direction.
Would you label this a crisis today?
So I did a video on that. What do we mean by a crisis? Well, a crisis is either, you know what? Right now the interest payment is $900 billion, which is the size of the defense budget. But at some point, right, because we're adding 1.9 trillion, which we keep refinancing, right? So we keep adding more and more, and with 33 trillion, 34 trillion, 40 trillion, 50 trillion, 60. At some point, we don't make enough money even to pay the interest anymore, right? It becomes too much. Then we have a crisis. In their case, what they're thinking about is, that's going to happen maybe in 20 years from now. But what if someone, when they had that $1.9 trillion and you go to the market, hey guys, I need 1.9 trillion because I need to pay that deficit. I need to borrow more money. And they said, nope, we're not lending you any more money. That's a crisis.
It's not a crisis today. I was looking at your screen. The 10-year yield is just over 4.2 as of this morning. That's not a crisis. It's manageable. It's a challenge that's growing over time, and that's.
It's not a crisis. It's a challenge that is growing over time.
The problem is that we need to act now to head off the bigger problem in the years to come.
I feel like I've been listening to the same story for more than 20 years. People warn that this needs to happen. We have not hit a crisis point. We have not had a point where buyers say, forget it, we're not buying any more of your debt.
Exactly. We're not there yet. But did you see all the 8 items I told you about? in order for you to fix this? Do you hear any of the candidates addressing that? No. What they're telling you is, I'm going to lower taxes, we're going to fight inflation, i.e. we're going to lower rates, but that's not really going to help you that much anymore. We're gonna grow the economy. Okay, then maybe that's the only. But if you're growing the economy and you're going to lower taxes, are you really going to help?
We haven't seen Treasury yields skyrocket as a result. And so people have.
Meaning that what's going to happen is, if you say 4% and nobody wants it, what do you think you're going to do? You're going to say, well, if I give you 6%, what if I give you 7%? Would you borrow the money then? How about I give you 10%? So the risk is rising, therefore the rate goes higher. Because this is the risk, rate is essentially the risk. The more riskier you are, the more money you pay.
Come a little inured to this. When do you think the stuff really does hit the fan?
Yeah, now I think what you pointed out is really important. That A, there's not a crisis today, but B, the risks are rising.
So as an investor, do you want to wait for the crisis to happen and then you make decision on it? This is where you make money as an investor. You need to know where the risks are, and you need to act before it happens, before that happens.
And the challenge for policymakers is to look ahead and to say, I can't identify exactly when the crisis point will come, when the rest of the world will hesitate to buy U.S. securities, to buy Treasury securities. But we know it's coming, and we need to act before then.
We know it's coming when people are going to say, no more, I am not lending you any more money. Have you tried to borrow more money when your credit score is 500? It's too late. They stop you here. Why not the government?
And it's going to be a challenge for whoever is the next president to look out ahead and address the fiscal challenge.
The only issue that you're having, obviously, is these people want to be elected. Do you really think that whoever gets up there says, hey, you know what? I am going to raise taxes, I'm going to cut entitlement, I'm going to make you retire at 75, I'm going to cut certain entitlement. You don't want to hear that. You want to be told a nice story. You want to be told that I'm going to lower taxes and grow the economy, and lower interest rates. Right? That's what you want to hear. Yeah, that's what you want to hear. But you're a child in that case, right? You're not being realistic. You're heading in the wrong direction. There's got to be some pain. Not today, but you're going to have it tomorrow, i.e. in 10 years. If you're retiring in 10 years, there may not be money to actually pay for the Social Security. Well, that's not possible. Let's just raise more money. They may not lend you any more money because you're at 1.9 trillion deficit right now. So if you're going to do more, then what are you going to do? You're going to borrow more money to pay for the deficit created by the Social Security that you're paying all these people? What if they don't lend you the money? Then the 1.9 trillion stays out there. Nobody wants it. Nobody's going to finance you. Then you're not getting paid your Social Security. You're not going to get your check. Oh, that can't be. Then you could print more money. Then go ahead. But then you're going to devalue the currency and you're going to create inflation. Oops.
Neither party seems to be stepping in and saying, you're right, we need to do something about this. Both sides seem to be looking at spending more.
Look, there are many challenges facing the country, and policymakers want, lots of different things: more national security spending, more social spending.
Yeah, we're financing a bunch of wars, right? Because we need to protect democracy. I'm not saying one way or the other. Be aware that money that you're spending, you don't have it technically, right? Because you have a deficit of 1.9 trillion. If you're going to spend more money because of a new war somewhere, that goes on top of the $1.9 trillion.
Some policymakers want tax relief. There's the 2017 Tax Act. Much of it expires next year.
You want more tax reductions. So we are taking in less money. So that 1.9 trillion is going to grow even higher.
year. So there's lots of desires for spending or tax relief, and that's the challenge: is to address those desires in a fiscally responsible way.
We talk about modern monetary theory, the idea that it's okay, you just print more, or you maintain rates, you lower rates, we'll work our way out of this. What do you say when you are given those options by leaders on the Hill?
Yeah, that was something that when I started at CBO in 2019, I heard a lot about. And it seemed like a philosophy more than an economic theory. And now, after the high inflation that we saw in 2021, 2022, the inflation's come down, but those discussions of printing money and, sort of unlimited spending have subsided. So
the two good kind of thing that is kind of happening that should be kind of okay is they realize over there in the big building in the back in Capitol Hill that, you know what, we can't print any more money. Okay, let's take it easy on that. And the other thing that you have going for you is that the US economy is strong. So obviously, as it expands, right, there's more money coming in, so there's more taxes coming in as well without taxing the existing people. So, and we have sometimes, and those people are still financing us by buying the treasury. So we're still okay for a certain time, but for how long?
Maybe that's the first step toward fiscal adjustment is, in some sense, focusing on the problem.
Have you ever heard?
Correct. Focusing on the problem. And that's what we're going to need to do. We are going to need to focus on the problem. So as an investor who wants to make money, I mean, there is no trade on this, but be aware of it, right? I know you can't buy options over a 10-year period. I know the most options you could buy for 2 years. Spitznagel made a lot of money by going long-dated option. Maybe you buy a 2-year option on the S&P 500, a put option that, if this thing comes out and somebody doesn't buy our debt and we go crazy, the market collapses. Bingo, you're out there, you're hedged, right? And this is another thing that I think investors need to be aware of, is that you need to you need to protect what you have. You can't be looking for Nvidia, Tyson, Nvidia, Tesla. Okay, but even if you make money that way, you could lose all of it because of something like huge, like the deficit that's coming closer and closer and closer to the crisis. I mean, it's a challenge right now. It's not a crisis, but it's a challenge. So you owe it to yourself to protect your book. I mean, usually it's 60 stocks and 40% bonds. Maybe you should do 55, 45, and 10%. Options or some sort of a hedge on your portfolio that doesn't cost you too much. You may end up losing it and nothing happens, but if it does happen, boom, it could explode. That's how Spitznagel made a lot of money going short the market, but over a long period of time. It doesn't cost a lot of money to hedge it. Probably you're not going to use it because you will never hit the threshold, but who knows, right? That's what you need to do. That's what you need to understand. That is what you need to focus yourself. So don't forget to subscribe. Don't forget to like this video. And I mean, keep that in mind. Be aware what's happening. At least at least I told you.